Joining us for more now is Scott Phillips from the Motley Fool. Scott, happy Friday to you. Look, we're at record highs again, looking for another positive session on the local markets. What are you making of this? Of course, it all comes ahead of earnings season.
It does, and I've got to say, a really important earnings season. A couple of things going. Let's do the highs first. A reminder, by the way, markets tend to set new highs. There are people who run away from these things when there is a high and say, oh, it's now at a high, it must go down from here. The reverse is actually true. Over time, the market goes up rather than down. So be very careful trying to time the market. Be very careful as well, by the way, of making sure you're getting value for what you're buying, because when the market is at an all-time high, sentiment tends to be pretty positive. Prices tend to be elevated. For some companies, that means, frankly, too high. We've recommended sells on a couple of stocks over the last couple of weeks, maybe last month, on the basis of valuation alone. Great companies we love. You just look at them and go, oh, I can't pay that price. So there is an opportunity to take some profits when you get the opportunity, not because you've made a profit, but because the share price simply is too high relative to the future of even some of the best businesses. On the flip side, there is still value out there. And as I said, I do expect over time the market goes higher. Selling out at what it looked like an all-time high, missing the next all-time high and the one after that, generally not the best mathematical way to go about investing unless you're very good at timing the market, and very few people are. You mentioned earnings season, Andrew, and I think this is going to be one of the more interesting ones. Oh, I'm not sure that's true, actually. It's been very interesting since 2020. Every 6 months, we're trying to deal with what next. This will be probably, I would suspect, we might talk about rates in a second, this might be the last full earnings season before we get a rate cut. And obviously businesses will fare differently. Discretionary retail, we saw Country Road out yesterday. Mosaic Brands earlier in the week finally going into liquidation. They simply couldn't find a buyer. The bad businesses are being taken to the woodshed, in some cases disappearing altogether. And probably, I'll say deserve to, which sounds a bit harsh. The reality is we haven't had an economic cycle for years. People see business failures higher since the Great Recession. I think, oh, that's terrible. Higher since the GFC. Oh, that's terrible. It is for those businesses, it is for those employees. Except the GFC it wasn't even a recession for us really, but that kind of is the last time we had a proper cycle, right? Take out COVID, we had a 1 quarter of negative growth during the GFC, and then you got to go back to the early 90s to find a proper cycle. So we're not used to it anymore, but it's what happens. So that's important. Think about the discretionary retailers and the discretionary businesses in general that you own. The one whose customers don't need to use those services but do in the good times. They're the ones that might show some interesting numbers. The other thing we might see is the impact of exchange rates. We know the Aussie dollar, not for the whole half, so it's an interesting one, but for the last bit of the half, we might see a little bit of question about where those lower Australian dollar rates are hurting some businesses and helping others, by the way. So look out for that one. Last thing for me is the outlook, and we'll see what's happened since the end of earnings season, or the end of the half. That's almost more important, more interesting, because what we'll see is the whatever exchange rate, whatever kind of financial impacts people are bearing. I've said this before, when you look at 6 months, July to December, a lot changes over that time, right? If you had a terrible December, you won't see it in the July to December numbers because they're just hidden by the other 5 months. When someone says that since December 31, if that's their balance date, we've had this happen in the 4, 6, 8 weeks between then and when the company released its earnings, that's when you get a shorter period. That's more volatile. It's not always indicative. But we saw last earnings season, companies that reported, particularly their AGMs in October, and said, okay, since then we've seen this. And we saw some really marked changes in sales trajectory, revenue trajectory, even profitability in some cases, between the end of the half and that update. So that's also what I'll be paying very close attention to.
Well, of course, we've already had a raft of particularly production updates in the resources sector. Look, MinRes certainly a focus in the last day or so. We know the issues that it's been through, certainly in terms of management. How are you seeing that stock at the moment, the pressure's being brought to bear on it?
Yeah, it's tough, isn't it? I think, so the first reminder for investors should be that this ASIC inquiry or investigation or interest, you kind of should have expected it, but some investors will have said, hey, the bad news is out of the way. Chris Ellison has fallen on his proverbial sword, at least, saying, look, I did the wrong thing. I'm sorry, I won't do it again. And some people would have ruled the line of that and said, great, that's done. If there is any sense that the corporate regulator might want to have a bit of a look, and we shouldn't prejudge this, who knows what's going to happen next. But a reminder that things aren't over just because it drops out of their headlines. There's always the chance, and law enforcement tends to be like that, right? You get an investigation, you get potentially charges or other actions taken some months after the news is broken. So just be mindful of that. Again, I don't want to prejudge it. ASIC may say nothing and go away. but it's worth thinking about what the impact is there. I don't suspect we're going to see meaningful impact on the company's profitability as a result of this. We may yet see impact on who's allowed to run the company or work for the company. We're talking about directors here. So that could be problematic if you believe, and I think it's probably reasonable, that certain directors have an outsized influence on the company, and should, because they're really, really good at that part of what they do. So that's a bit of a risk for investors. Any financial penalty is probably relatively small in the scheme of things, so I'm not too worried about that. The MinRes story is a lithium story, at least in terms of the way the market's been whipsawing it around. I remain very cautious on lithium. You know this, Andrew, and I will be probably for years, even as the price fluctuates to highs and lows, because we haven't yet seen it net out. We don't know what the long-term demand or supply looks like. We don't know what the long-term margins look like. So you're punting on either short-term sentiment, trying to trade this thing. Maybe you're punting on a short-term price of the commodity. Again, that's incredibly difficult to do. If you're trying to use fundamentals, it's almost impossible to look at a business like MinRes and say it will make this much money, even roughly, in 3, 5, or 7 years' time, without knowing the price. All commodity players are like that. You control your own operations. You do a great job there. No matter how good a job you do, the biggest impact by a factor of, 2, 3, 4, 5, 6 times is the price of the commodity you're mining or drilling. So that remains the big challenge for MinRes.
All right. Look, another stock in focus, which is a result of a merger, a mega merger, if you like, in the pharmacy space. Sigma, Chemist Warehouse. What are you making of this new entity?
Deal done in 16 minutes, and no surprise either. Sigma shares have tripled in the last year. The shareholders are not going to vote that one down and see the share price fall again. It was always a fait accompli. So no surprise that's gone ahead. Chemist Warehouse, mate, one of the very best retail businesses in the country. And what I'm actually looking forward to, selfishly, is the ability to see those numbers publicly for the first time and see them as they roll forward. We've seen obviously the numbers in the prospectus and stuff, but the roll forward of what does this look like as an operating business on the ASX will be amazing to watch. They did $5 billion in sales in the last 6 months. A $10 billion run rate annualized is about a fifth of what Woolies do. I mean, you kind of think Chemist Warehouse, we kind of think the pharmacy sector is relatively small and we focus on the grocers or others in the retail space. This is an absolute juggernaut. The job they've done, I used to work for Blackmores years ago, the job they've done, basically disrupting the entire pharmacy industry has been astonishing. And that was just quality retail. If you're not following this one closely, the best analogy is actually JB Hi-Fi. And I don't mean to elevate it to that sort of level of quality necessarily, but the way they go about their retailing efforts is very much I won't say a carbon copy, because I'm not sure they did copy it directly, but in terms of your thinking about it as an investor, they are doing effectively what JB Hi-Fi. It's the bargain hunting, stack it high, watch it fly, big discounts, kind of the messiness in store. That is a really, really compelling retail offering. We've seen it do incredibly well. They took on a staid, boring industry with high margins. It's the old Jeff Bezos line, your margin is my opportunity, and Chemist Warehouse has grabbed that and run with it. Just be a little bit careful when you're buying the shares. There is some sense that maybe the index funds will buy into it. That's probable. Is it long lasting in terms of the impact on the share price? I don't think so. And again, Sigma share price already risen on the back of it. The news is known. Doesn't mean it won't move from here. So I'm not saying, I'm not giving a forecast on the short term, but be mindful of that. The other thing to be careful with Chemist Warehouse, again, I love it as a business, but it is absolutely benefiting from government legislation and regulation, which says you can only have so many pharmacies, they must be owned by a pharmacist. That kind of, it's frankly anti-competitive. It's a ridiculous set of laws. Sorry to any pharmacists watching this morning, but we should remove those laws. There's no reason for them other than governments, plural, both stripes, fear the pharmacy lobby and the pharmacy guild. But if those rules were to be relaxed or removed, Chemist Warehouse is not going to hurt most. By the way, it's going to be the small guys. But just be mindful that all of a sudden, if Chemist Warehouse found itself competing with Woolies or Coles or something else, the game would change meaningfully. So just keep that in mind. But love the business, love what it's done, and looking forward to watching it.
Scott, just very quickly before you go, in the wake of the DeepSeek emergence out of China, the whole question in regards to infrastructure, particularly being spent on AI-related tech. Any particular implications here in Australia, do you think? I mean, we saw the impact certainly on the data centres and the like.
Yes. Yeah, NextDC is the big one. Mate, look, what I would say to people is AI is going to be spectacularly huge in terms of its impact on the way we go about our lives and do our businesses. That's absolutely true. Do we yet know, like the internet in 1995, who is going to win from this? Absolutely not. So be really, really careful. I'm not saying don't invest in the sector. What I am saying is if you're going to do it, make sure you're paying a good price. Make sure you're diversified. Expect volatility. NVIDIA we've seen all week, up, down 17, up 6, down 6. I haven't even caught up with the numbers overnight, probably up or down again by something similar, I would suspect. But this is speculators trying to adjust their speculations. And I don't say that pejoratively, mate. There's nothing wrong with that. Just be mindful of what you're doing. We don't know how this plays out. It's probable that there are more data centers required. It's probable that the incumbents will have a pretty good chance of being among the big movers in that space. But it's very possible that, like the internet, or even airlines, think about airlines. You've got the airports, the airlines, and the consumers. Who won most? The consumers by a mile. Airports did pretty well. Airlines did terribly. Now, am I saying that'll be the same model? No, absolutely not. If you wanted to make that model, though, the airlines might be the AI companies, the airports might be the data centers, and the consumers are us. We win and businesses, because things will be done more quickly at higher quality at lower cost. So take the win. That's going to be great. Just be really careful investing at this point. You couldn't have put money on the internet in 1995 and been even close to right. You might have jagged Amazon, which is really a retailer and an internet company. I own shares, by the way. You might have invested in Cisco and then some cable companies and Telstra. We saw that, frankly, during the Telstra listing at $7+ bucks. I don't think it's ever been there since. So just be really, really careful. But exciting times ahead. Really worth watching for investors. Just be careful how much certainty you assume in the extrapolation of what's happening now for the next 3, 5, or 10 years.